There are two ways of approaching the topic of return of equity, on equity, ROE, as it applies to real estate investments. In each of them, return has the same meaning as cash flow after taxes. So we talked about cash flow before taxes. Now there's also cash flow after taxes. What differs is the meaning of equity in the word. In the traditional method, the equity is the initial cash investment you made when you bought a property. This is then very similar to the cash-on-cash return calculation we did from before, with the difference of cash flow before taxes being mentioned in that particular calculation. In the alternative technique, it is your initial cash plus the additional equity that has built up due to the amortization of the mortgage and the increase in the value of the property over time. The ROE is expressed as a percentage, okay? Just like cash on cash return. And typically is calculated for the first year only. However, it can tell some interesting information in the following years as well. So, how to calculate the ROE, the return on equity? You basically take your cash flow after taxes and you divide it by your initial cash investment. So what that means is, we talked about cash flow before taxes. This is cash flow after taxes. So whatever your cash flow calculation was, basically that was before you took into consideration your depreciation, your taxable items, and now you're left with this nugget, whatever you have after taxes. That amount is what you take and you divide by your down payment, your equity, which you first put initially in that deal to then calculate your return on equity, okay? So we'll try to give you a quick example. You purchase a property with $100,000 down. The first year, your cash flow after taxes is $9,000. What is your return on equity? So you take your down payment and your $9,000 and you get a calculation of 9% is the return on equity. It's very similar to your cash on cash, what we did before, or cap rate. So hopefully that summarizes return on equity. You guys get this quick, easy, very simple term. Going to move forward to what we call the profitability index, okay? There's another interesting term that maybe some of you guys have never even heard about. The profitability index, the PI, is similar to the NPV, net present value, which we're going to talk about in a second. It's a method to measure the return on an investment. When calculating NPV, the purchase price is subtracted from the asset's present value, the PV, of future cash flows. Okay, that's a little fucking perplexed. Even for me, it's a tongue twister. But it means if the number is zero or a number is positive, then you have exceeded or equaled the rate of return that is required, what we call your discount rate, your rate of return. Your desired rate of return. The profitability index instead calculates the ratio between the initial investment and the present value of future cash flows. If the initial investment and the present value of future cash flow are exactly equal, then the index is 1. This means that with a PI of 1, your investment achieves exactly the rate of return that you had targeted for. Or simply that your internal rate of return, your IRR, which we didn't talk about, it's another very, very important term, equals your desired discount rate, your desired goal in the calculation of its present value. If it is above 1, you have exceeded the rate of return goal, right? So if you manage to get a higher number, then you're making more than you actually desired to make in the beginning. This means that you have not reached the goal and your internal rate of return is lower than your discount rate, okay? The profitability index makes it easier to compare properties that have a different purchase price. This is because the profitability index is a ratio, a percentage, showing us each investment's portion of the dollar that is returned versus the dollar invested initially. Okay? So how to calculate profitability index? You take the present value of future cash flows and you divide that by your initial cash investment. Okay? Hopefully our example could better articulate this. It's a tongue twister. It's a little more complicated. For those of you guys who've been paying attention, it's probably more of our progressive terms to learn, but I thought I'd throw it in there as well. You expect to purchase, in this example, you expect to purchase a property using a $75,000 cash investment, your down payment, and you forecast that you will have the following cash flows. So you break it down for the next 5 years. You make 700 cash flow first year, 900 second year, 1,150 third year, all the way up to 1,500 your fifth year. You also estimate that the sale of your sale of your property 5 years from now will be at 125,000. Okay? You believe that your investment capital should receive an 11.5% annual return. So that's your discount rate. 11.5% is where you want to make on your money over the next so much period of time. So you choose to discount all future cash flows at that rate. So that's your desired rate of return for every year for the next 5 years. What is the discounted cash flow and the profitability index of this investment based on that? So again, recap, you take your present value of future cash flows and you divide it by the initial cash flow investment, and your purchase price is 75, your discount rate is 11.5%, and your sale price is 125. You take a cash flow chart, you build out each of your incomes for that year, which is clearly outlined here, and you see what your present values are for each line item to then get a present value for all of them at the very bottom, which in this case is $76,000 or so. So this is an interesting indicator to then get you the profitability index, which is 1.02. So that basically says you're making what you said or desired to make, which was that 11.5%, but your internal rate of return is not there yet, so it takes time to get to that point. At the end of it, you will get to that point and then some. So that was profitability index. I'm going to leave you guys with net present value, and this is the last term we're going to cover today. And I appreciate, for those of you guys who stuck around to this point, I appreciate you guys listening, and hopefully, again, this is valuable content for you guys to learn from. So let's say you require a 10.5% rate of return on your investment, okay? When you discount all the expected future cash flows back at that rate, then the present value that you find as your answer is the amount of cash you need to invest at the 10.5% to achieve those future cash flows with exactly the same timing and amount that you had predicted. So what does that mean? So let's say you want to make 10%, or in this case 10.5% on your money. You're going to invest $100,000 is what you're saying, but you want to calculate whether that $100,000 is sufficient in that particular transaction in order to attain that 10% return over the course of your investment. So by playing with the down payment amount and the attributes of the deal, you'll be able to see whether or not that initial cash investment can actually get you that 10% or 10.5% return. That's what it does. The discount cash flow analysis tells you what the future cash flows are worth at a given rate of return, but that isn't necessarily how much you're going to pay for them. This is where NPV, net present value, comes in. Net present value is the difference between the present value of all future cash flows and the amount of cash you invest to purchase those cash flows, what you put in initially. That's why it's called net present value. Hopefully that makes sense. If you invest exactly what the future cash flows are worth at a given discount rate, your rate of return, right? Discount rate, rate of return, then your investment is earning exactly that rate. If the present value of the cash flow is greater than the amount of your investment, you have what we call a positive net present value, which is another way of saying that you're doing better than the specified rate of return that you wanted because you're getting more than you expected from your investment. If, however, the PV, the present value of the cash flows, is less than the amount of your investment, then you're going to get a negative NPV. That means that you're not doing as well as you specified as a rate of return when you initially started. A term closely related to NPV is that profitability index we just spoke about a moment ago. So how do you calculate net present value? Okay, net present value equals the present value of future cash flows minus your initial cash investment, that equity you put down. Okay, so an example to this, we're going to try to do one, and we're going to call it a quits for the day. Let's say you expect to purchase a property using a $75,000 cash investment, and you forecast, right? You project that you will have the following cash flows over the next 5 years, 700 all the way up to 1,500 in year 5. You also estimate that the sale of your property 5 years down the line will produce you that 125. This is very similar to the previous example. You believe your investment capital should achieve 11.5% return on an annual basis. That's what your goal is. You want to make 11.5%. So you choose to discount that, meaning you choose that rate for all of your cash flows for the next 5 years. Evaluating commercial real estate or just real estate in general using the income approach. And we got an example up here that we're going to go through of a 10-unit apartment complex. Okay? Doesn't matter where, it's just 10 units. And it's saying in this example that you can rent out the 10 units for, what is that, $700 a month, PGOI, which is projected, prospective, gross operating income, which is also the PSI, the projected scheduled income, gross income. Okay? The current occupancy is 90%. Okay? Occupancy means how many people are actually there, how many units are actually leased. So 90% of the 10 units, so 9 out of 10 are leased. One of them is what? Vacant. Okay? So your vacancy is 10%. 1 out of 10 is 10%. The taxes and utilities are $4,000 a year. That's your expenses in a nutshell. Okay? There's more expenses, but assuming those are the lot of all of your expenses. It says here that the cap rate, which we talked about a second ago, for this market that you're buying this property is normally at a 5% rate of return. And the seller's asking price is $1.4 million. So in this particular instance, they're asking for, what is your NOI? Is the property underpriced? So those are the two different things we're going to seek out and look for. We have a bunch of data in this example, and I'm going to walk you through how to do the math. Okay? Always when you do, I don't know if you guys ever are good at testing or doing any kind of math algebra. I was a pretty decent student in math. I highly recommend for those of you guys who are not good at your math to brush up on it. This is pretty basic stuff, but without sounding too condescending, this is a very learnable, easy thing to go over that all of you guys should know and be able to calculate if you want to get into the real estate game. So, NOI, the calculation for NOI is what? It's the GOI minus vacancy. Okay? So you get GOI minus vacancy. In this case, it's saying the current occupancy is 90%. The units can be rented out for $700 a month. So 7 times 10, there's 10 units. That's, what is that, $7,000 a year or a month. Is that for $700 for each unit or $700 for total? Each unit? So it's $7,000 a month. So it's $7,000 a month in possible income, and then you're going to take that and you're going to annualize it. So you're going to take 7,000, I'm going to bring out my calculator because I want to do quick math, times 12, you're going to get $84,000 in projected gross income, your PGOI, okay, your scheduled income. Then it says there is only 90% of it is going to be occupied. So there's a 10% vacancy factor. You can do this two ways. You can either do 10% of that 84,000, which is 8,400, and subtract it from your PGOI, or you can just say, okay, I know my PGOI is 84,000. I'll just multiply it by 90 cents on the dollar, 90% of it. That's what's actually occupied to get my GOI, gross operating income, the actual income being produced. So in this case, I'll do the quick math. I'll take 84,000, which is my PGOI, multiply it by 90%, and I'm going to get $75,600. Okay? 75,600 is your GOI. Now, how do you get your NOI? So now that we have our GOI, NOI again was GOI minus expenses. Okay? Your expenses here are $4,000 a year. So assuming the math is correct here, you're going to take your $75,600 and you're going to subtract $4,000, which sounds very low. And I think based on this math, we might have made a mistake with your initial calculation of $700 a month, but we'll assume not. That becomes $71,600 in NOI. Again, recap, quick. We took the previous amount, which is the GOI. We subtracted $4,000 of expenses from it, and we got our NOI. So the answer to the first portion of this question is $71,600 based on this math. Okay, the second portion of the question says, is the property underpriced? Is it a good deal or not? So the average market rate of return is 5%. The cap rate's 5% in this market. The seller's asking 1.4, and our NOI is $71,600. How do you calculate the cap rate? That's basically what they're asking us. So you got to take your NOI, you divide it by the purchase price, 1.4. So our NOI was $71,600, and we're going to divide that by $1.4 million, and we're going to get 5.1%, okay? So it's literally at market or a little bit right above, underneath, what market should be worth. So is the property underpriced? The answer is yes, it is underpriced slightly. It's really at market or just underpriced. So it's a reasonable deal because most property out there is selling for a 5 cap. So the deal makes sense. Now that doesn't mean that it makes sense for you or for your buyer and your investor. It just means that the marketplace, based on today's current state, is transacting at that level. So I hope that example gave you some perspective. We talked about GOI, NOI, vacancy, occupancy, cap rate, and whether or not a deal was underpriced or not. That was this example. So here it did the math for us. I didn't realize you have the math on the next page, so good to know. So in this example, it gave you how to get the NOI. It gave you the value. For those of you guys who are watching on the screen here, you can recap that and take a look. Good. Now the next question, or next example we're going to cover is, if a bank provides financing for that very same deal, at an 80% LTV with an interest-only loan amount of 5%, what is the cash-on-cash return? So let's cover a few of the points that are being asked here before we talk about it. What is an LTV? What is financing? Okay, financing is the term, really that means you go and getting your mortgage, you leveraging your money to buy the deal. The bank obviously being the institution giving you the loan, they're willing to give you 80% LTV. LTV stands for loan to value. That means 80% of whatever the property is being bought for or that it's appraised for, whichever is less, that's what they're going to give you that 80% value on. And that'll become your loan. The interest-only loan amount means that you're going to only be paying for that loan amount only interest. There's going to be no principal payments towards that loan in your debt service. And it's at 5% annualized rate. Okay? So now they're asking, what is your cash-on-cash return? And we're going to cover that in a second. So the math here is, first you need to calculate what your LTV is and then what your debt service looks like on an annualized basis. And the first row here covers that. They're saying if you're buying it for $1.4 million, okay? Assuming that's what it's worth and that's what it appraised for. Make life simple. 80% of it, LTV, if you take 80%, you convert it to a decimal, it's 0.8. You take 1.4 million, you multiply it by 0.8, which I'll do, and you're going to get $1,120,000. Okay? That's your loan amount based at that 80% LTV and that $1.4 million valuation. Now, how do you know what your debt service is? Well, you have your interest rate, which is interest only, very simple, basic, straightforward at 5%, and you multiply that by your loan amount, which in this case is at 1.1 million or so. So I'm going to take that 1.12 million and I'll multiply it by 5%. Okay, if those of you guys are punching in the calculator, just make it a decimal. It's 5% is 0.05, and you get $56,000 in annual debt service. Okay, now how do you get cash flow? That's a component of getting your cash on cash return. And remember, cash flow is a dollar amount. Cash on cash return is a percentage, just like cap rate. Okay? So you have your annual debt service, you have your NOI. The NOI, if you recall from the previous example, was $71,600. And what you need to do is, to get your cash flow, you subtract your NOI by the debt service. In this case, it's $71,600 minus $56,000. You get an annual cash flow, right? Everything's on an annualized basis of $15,600. Okay? That's your annual cash flow. That's what you actually net put in your pocket after all the expenses, after paying your mortgage, after dealing with the vacancy. That's what you pocket on this deal. Okay? So now, they said you went and bought this building with a loan, leveraging it, right? You didn't pay a $1.4 million cash, you put a down payment. So how do you calculate what that down payment or that initial capital equity investment is? If 100% is the whole $1.4 million to put down and buy, you're only using 80% of the bank's money. So which means if you take 100 minus 80, you get 20% is what you're gonna have to put down. Now how do you get a dollar amount? Quick math. 1.4 million, which is your asking price or purchase price, multiply it, right, by 20%, or in this case it's 0.2. You get $280,000 is what your down payment's gonna have to be to buy this deal, okay? Now, that is your down payment. The annualized cash flow is $15,600. What's the math for cash on cash return? You take your $15,600 and you divide it by your down payment, which in this case is $280,000. And you end up getting a 5.57% cash on cash rate of return. Okay? And notice that rate of return is actually slightly higher because you're leveraging your money than buying it cash. Okay? The reality is, if you took your debt service and put it into consideration, if you removed it, it would be a whole different ballgame. So leveraging money plays a factor in buying your real estate and how you buy your real estate and what your rate of return is going to be in that deal. Hopefully that makes sense. So how do you consider what is a good deal? Okay? How are we doing on time? 3 minutes, good. Okay, we'll try to get this. When I look for investment property, okay, there's 2 ways to look at how you buy a building or a deal. It's either going to be based on appreciation or cash flow. The ideal scenario is both, right? You want to be able to collect a high rate of return, and you want that rate of return to grow in appreciation in the shortest span of time. Okay, the reality though is, in the marketplace, some markets are going to give you a very low rate of return, very low cash flow, but they're going to go up in value because of demand in the marketplace and scarcity of inventory, which drives the price up. So major metropolitans like Los Angeles, New York, here in Miami, Chicago, these cities, Boston for example, will drive the prices up but make very poor rate of returns for investors. Okay? When I try to invest my money, when I actually buy an asset, my goal and objective is to cash flow at the highest level I can, okay? Because I want to park my money and I want my money to work for me to be able to ascertain the highest level of cash on cash rate of return or cash flow for myself and for my family. When I look at a deal, if it's not producing me at least a double digit, 10% or higher rate of return on cash, I'm not interested in the deal, okay? That's me personally. Everybody has their own thresholds, okay? Some guys, they don't even care about the cash on cash return because they look at it over the course of 10 years or 20 years of ownership. They know their cash on cash rate of return is going to go gradually and steadily up because over time, the rents are going to go up. And so your initial investment is going to probably stay exactly where it was, right? You put $100,000 in, but the rents are going to go up, which is going to what? Drive your NOI up, which is going to indirectly drive up your rate of return. So people look at it differently. I look at it, I'm trying to make money today or in the next 24, 36 months. I want to make the highest rate of return for my investment. Okay? An 8 to 12% cash on cash rate of return is what an ideal investor is looking for in the course of acquiring a property, especially commercial property. Multifamily in particular, people might buy deals at a 5 or 6% or even 4 something percent cap rate or rate of return, and then they know over the next 5 years or 60 months that 4 or 5 might become a 7, 8, or 9 rate of return cash flow. So again, longevity definitely plays a factor in ownership in your strategy to make money for yourself and for your family. Some people go for up to 20% or higher cash on cash return, which actually exists. I was on LoopNet, a website, it's a marketplace for those of you guys don't know it, and I was looking through the manure, as I call it, the garbage of what's out there, and I saw that there are deals that exist where you can buy things for over a 20% rate of return. They're gonna be in the boonies. They're gonna be in places where you wouldn't be caught dead walking around after 5 p.m. in the afternoon. It's that dangerous. But if you're willing to take the risk and live on the edge, you can make very high rate of returns that way. I am not that type of person. I wouldn't take the risk. I don't recommend you do it either. I think finding something within the margin of reason is really what's going to get you ahead. Okay, guys, look, I'm going to go out on a whim, all right? And I'm going to go on to LoopNet, which is a marketplace in real time. And for those of you guys who don't know this website, I'm going to introduce it to you. LoopNet is one of the largest commercial real estate websites in the world. It's owned by a company called CoStar, which we do not subscribe to and we do not pay $1 to for a multitude of reasons, but it's a place where you can actually search for deals. Another website that I can recommend for finding deals is Crexi.com. Okay, that's CREXI.com. That's another competing marketplace. It's a newer company. Another one that you guys can look at is Brevitas.com. That's BREVITAS.com. These are 3 different commercial real estate marketplaces that you could go into and start searching for your next deal, okay? If you don't know how to find off-market deals, if you don't have any relationships, and you just want to practice the underwriting potential of what you just learned, right? These tentative basic terms and numbers and formulas, then the simplest way to actually exercise your skill set is to be able to go onto one of these marketplaces, find an active listing, right? Something for sale. Without even talking to the broker necessarily, just take the data from the offering memorandums and then start formulating and calculating so that you can get better at underwriting the deal and seeing if whether or not the deal makes sense or doesn't make sense. It's above market or below market based on the income approach, right? And this is a very smart way for you guys to be able to exercise your ability to calculate and evaluate deals based on the income approach, okay? In addition to that, I'm gonna give you guys an inside scoop to a software we use called BuildOut, okay? Those of you guys don't know this company, BuildOut is only a few years old, and we started using them about 3-4 years ago. They create marketing memorandums, offering memorandums, right? Brochures. So if you get a listing or if you get a deal in your hand and you want to promote that deal, so they'll make it very pretty for you. They'll give you the basis to be able to underwrite, to plug in a bunch of data, to get some basic presentation out to the marketplace, okay? So one of the tools I use in BuildOut, okay, which I want to show you guys, mind you, this software, these applications, this is the only one I'm actually paying for. Each one of the other ones has a free subscription for the marketplaces. LoopNet does. I would highly recommend never paying for LoopNet because you can pretty much get any information that LoopNet provides, the vital things, as a free subscriber. Crexi and Brevitas, they have great added value for their paying platforms. They include CRMs. One of them includes off-market directory of listings. So I would invest in those things. But BuildOut is, for a lot of you, going to be a very expensive tool. But for us, and this is a demo environment, it's a very valuable tool because it allows us to take all of our off-market deals, because that's what we focus on here in our company at MTIP. We focus on attracting off-market opportunities, and then we take those opportunities and we plug them in to a variety of different softwares so that we can underwrite our deals and see whether or not, if they make sense, if they don't make sense for us to buy, or for the next guy that we want to sell it to have skin in the game as well. So one of the cool features about Build Out, if you go into an example here of a listing, is you can edit the property and you can put in all the information, the pedigree, the square footage, the zone, everything you want that you can get from really public records or the title company, or in our case, we get from Reonomy.com, which was the resource we used to research property. But there's a segment here which I really like, which is the financial segment, okay? And that covers the ability to plug in a bunch of information that's relevant to the income and the expenses to ascertain the rate of return, right? So there's gonna be place here for you to plug in the purchase price, okay? There's gonna be a place here for you to line item list all of the different incomes or expenses, okay? You're going to get automatic calculations for stuff like the gross scheduled income, the total scheduled income, the vacancy percentage or actual number, and your GOI. You're gonna get your NOI here. You're gonna get your cap rate here. It also has a segment that talks about the financing aspect, which we kind of covered. Your LTV, your loan amount, your down payment amount, your debt service on an annualized basis, your cash flow without taxes, your total rate of return, your debt coverage ratio, and your cash on cash ratio. All of this stuff is actually in the system, and all you need to do is just plug in a few numbers that you would either get from the owner or from a marketing brochure on one of these marketplaces on the listings, and you can start processing deals and calculating whether or not these deals make sense. So there's a sundry of tools that can help you compute these basic math formulas that we kind of covered this week in today's presentation, as well as the prior weeks. And you could also, you guys, take the time, go online, okay? There's a ton of resources. If you guys go to YouTube and you can plug in what is NOI, what is GOI, there's gonna be a million videos you guys can watch outside of yours truly explaining this stuff to you. And these are the elementary steps of getting into the game. You guys need to understand the lingo, how to calculate this stuff, and then how to be able to negotiate based on the formulations, based on the math that you've learned, okay? This is kind of the rudimentary steps. There is another website that's more affordable that I also want to suggest to you guys. It's called Creop. Creop is a competitor to Build Out, but what's nice about this website, Creop, is that it actually projects, does cash flow analysis, what we were talking about today, what your cash on cash return is, all that stuff, over a longer period of time, such as 10 years. So you can see if you wanted to buy it today and see what you're gonna exit out, year 3, year 5, year 10, how long you wanna hold that property, and what that income is gonna be like in the future based on the data that you provide. Creop can help you actually create an amazing report. Again, this is plug and play. I think they're like under $100 a month. Another great tool. Bigger Pockets is another resource a lot of people use in the residential world to be able to plug in data into a form and get out a report. You're gonna, listen to me, a lot of you guys will just use, a piece of paper and a pen. That's okay too. I don't care what level you are. If you can afford these softwares, I threw them out there to help you guys get ahead. If you guys cannot afford it, then, chicken scratch it is. But ultimately, you're gonna have to learn what these things mean. You're gonna have to know how to apply them and calculate them in order to stand a chance out there, because the competition is fierce, guys. It's fucking fierce. If you guys don't know what you're talking about, yet alone, even if you have money from your other business, if you don't know how to get into the door and be able to speak the lingo, you're not gonna get ahead. You're gonna end up having to create strategic partnerships with people you may or may not trust and build that. And that takes years, okay? So if you are a hands-on person, you want to take the initiative, you want to get ahead, you got to put in the time and learn this information. So with that being said, I'm going to hop back to our presentation here and we're going to wrap this week's chapter and talk about how you guys can take advantage of the information provided in this weekly offering that we keep talking about and really get ahead in your real estate or commercial real estate career with me and my team. Again, we have an online university. It's called MTIP University, okay? We cover over 20 plus hours of critical, invaluable content that covers everything you need to know to get started or to excel in commercial real estate and in business as well as life. Okay, I tell my personal story there. You guys want to get the opportunity to come and work with me and utilize these softwares and many, many more to learn how to get into the nitty-gritty of things, then this is your opportunity to take advantage and just register, okay? A lot of you guys have been registering and I appreciate that and we thank you for doing it, okay? But ultimately, it's about who's willing to not only put in the money, okay, as initial capital investment, but who's willing to put in their time and bleed with me and my company to get ahead. We have a tremendous amount of resources to be able to allocate to individuals that want to get seriously and aggressively into this business and push forward. So who is this for, right? We talk about over 40 different topics, but who's this really designed for? This program, this platform of ours, MTIP University, is really designed for someone that's just starting out in the business and needs guidance, needs mentorship, wants to know who's who and what's what. You are a candidate for this university. Someone that is lost, looking for a career opportunity, doesn't know where to place their efforts, wanting to make a 6-7 digit income on a residual basis over the course of the next 5, 10, 15, 20 year career span. This is the industry to do it in. And we are the partners to help you get you there, okay? If you're someone in sales today, any business in sales, and you're making a great income for yourself, great? Making 100 grand, you're making 200 grand, hell, you're making 300 grand plus. Amazing for you. But guess what? You're gonna be capped, okay? Because you're gonna always trade time for money. And in real estate and commercial real estate in particular, the beauty of it is you don't trade time for money. You let your money work for you. You let your investment vehicles produce that income for you and for your future of your family, your children, your grandchildren for generations to come. No other business can give you that opportunity on a guaranteed basis. Even after we're all gone, that piece of land is still going to be here and is still going to be thumping in that cash. Okay? You get appreciation, you get depreciation, you avoid paying or mitigating your taxes, and you get cash flow. Those are the advantages of commercial real estate or real estate in general. Okay? So if you're a salesperson, any industry, I welcome you to try to come on board and start working with me. I will show you how to take your income to the next level. Okay? To become an entrepreneur, a real business person, to invest your capital in your growth. If you are, last but not least, if you are someone that's kind of been through the ringer, all right? You've tried the real estate game, you tried a business and you failed. Guess what? Pick your ass up and try again, okay? Life is we're not the end of the ropes here because you failed. I actually encourage people to fail as soon as they can and as many times as they can in order to actually get ahead in life. Failures are lessons for us to overcome obstacles for us to grow. So if you guys had a bad taste in your mouth in the past, you guys didn't make it, the market crashed, you lost everything, let me be your guide. Let me and my team help you get ahead for the future to come. I can help you fix and adjust what you couldn't do on your own, okay? Last but not least, you have these other candidates. I mention them every week. There's more than these 3 people that are out there lecturing about real estate, how to get ahead in real estate, different programs. They're all trying to pitch you stuff. Listen, man, I'm not trying to sell you a product. I'm trying to sell you a lifetime career of generational wealth, okay? I have already made my income. I'm happy at where I'm in my life, and I have great aspirations to do much more as a young man. But the truth is, I'm passionate about what I'm doing, and I've built, with me and my team, we've built an amazing platform that can harness another 1,000 solid, great individuals, if not more, to push them ahead into their lives as well. And I'm here to offer you this, okay? Let me do all the grunt work for you. We've done it. Let me help you get ahead. No one else that I know of, and I'm out there in the market and I go to networking events and I meet people, no one's willing to take the blows for you, okay? Everybody out there is gonna make you wanna do literally slave work to get a moment of their time or a piece of their action. I'm not about that. I want you to get ahead from day one. What you put in, you get to keep, and what you don't, you're gonna lose forever. Remember that. It carried with me to this day. Okay? So in conclusion, guys, we're great on time. We got 1 more minute. I want to thank you for this week's rendezvous, as I call it, between us. I hope you guys learned something. We talked about commercial real estate. We talked about income approach. We talked about the terms. We gave you some great examples. We're going to start posting more of this stuff chopped up for you guys on Instagram, on YouTube. We have an amazing video editing team that's come on board to help us push it out. Again, this isn't my business. I'm in real estate. I'm not in broadcasting. I'm not in trying to motivate and encourage. I'm not here to be your best friend. I'm really here to help our company and our brand grow with enriched partners, strategic partners out there anywhere in the country. If you guys are eager to get into this business or are in the business and want to grow, I want to collaborate with you. I want to grow with you as two business people. Okay, I don't care what your gender is, what your race is, how old you are, what your financial condition is. If you have a drive, I want to know you.